Welcome back. Invest Info episode 36. This week we're going to talk about buying the dip. Um, Putting together this one because the market has been dipping with the 10-year yield bonds going up in price. So we see money move out of riskier assets such as stocks and moving into more secure assets such as bonds with fixed rates, right? So the rates go up, big money moves out, and a lot of the stocks that we love are actually going on sale right now. I have GameStop here, don't have any exposure. I don't think any of us do. But as you can see, it has wild swings on the 3 month chart. It spikes up the top and then at the bottom. And most people, more often than not, are buying at the top and selling at the bottom, right? Because emotions. And there's this notion of buying the dip. Most of us investing through these different apps, if you're active, um, it depends on the level you're at. You don't know what support is, so you're sort of buying on emotions, buying on what you think is fair, and it continues to dip. Now, certain people use charts or technical analysis before they actually buy the dip. Technical analysis (TA) technical analysis is not the end all be all, right? It just gives you an educated guess, but it's still a guess because this money uh, share prices could be fluctuated by institutional investors at their will. So if you think support is, let's use GameStop at 130, nothing is stopping an institutional guy to sell off 1 million shares and bring it down to who knows 110. Um, right. But our approach to investing is we're buying things at safety, and we're buying things on sale in a margin of safety price because from a valuation standpoint, am I getting a deal? Now, you might get a deal. You think with the price is a deal and it continues to dip more. Phil Town speaks about this. Warren Buffett speaks about this. You buy more so you can't buy any left. And in the long run, if you do the valuation of what you own, you know that you're getting something at a deal. Uh, you know, so if you're new to investing and you bought in with your friends, and the stocks continue to dip, and you say, you know what, I like the stock, I'm gonna buy the dip, and it continues to dip, you just have to wait. I mean, if you run out of money to buy, and that's really the problem, is that you're not after a while you appreciate the dips, you appreciate the red days, but when you've bought every single dip and it continues to dip, that's when the problem comes in. So I'll say, you buy the dip, 5% or 10-20% into the dip. Don't go all in. And if it continues to dip, you continue to add. And then if you see it's far, maybe like another 10%, then you just wait for the stock to reverse, wait for optimism to come back into the market. Then you begin to buy into the optimism. Um, but yeah, if you go into a position and the position dips on you and it continues to dip on you, there's no selling pressure. It's a lot of mind games, it's a lot of market manipulation that goes on to what to trick you into selling your shares, because when institutions want to move in, they want to move in cheap, and they have different tactics, short ladder tactics, and so on, to make you question really the decision you made in investing. But the best way to think is with a long-term horizon. Did you buy this thing on sale? If you did, good. Don't worry about if it continues to fluctuate in the price, because volume does affect uh, the current share price, but it has nothing to do with the overall value of the business, right? So, in terms of buying the dip, buy it. Buy the dip. Buy the dip. If something goes on sale, you get excited about it, you buy it. And if it continues to dip, you just wait it out and wait for the reversal. Because look, guys, pullbacks don't happen often in the long term. Recessions and bear markets don't happen often in the long term. When they come, people should be happy, not really fearful and dreading them. Because guess what? When the market turns back bullish again, it lasts way longer. We had an 11-year bull market. It lasts way longer than bear markets and recessions. So use these opportunities to buy every dip. Buy the dip and wait. If you're in and it continues to fall, if you understand what you own, then just wait. That's the best thing to do. Just wait, because that's what the institutionals investors normally have over the retailers, is the patience. So build up the patience. All right, I'll see you guys on the next one.